today. Okay, very important topic. Follow it till the end. Okay. Firstly, download Adda 24/7 app on your mobile. In this app, you will be getting all the premium study materials, plus live classes, plus notes, ebooks, tests, whatever you require. You get it over here. Also, subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting two things. Number one, all the updates on JAIIB and CAIIB, all the updates, latest ones. And second, you will be getting the free YouTube series on all the topics of JAIIB, CAIIB. Means what is this free YouTube series? Right now, what are you seeing right? This objective questions on this portfolio is a free YouTube series. So subscribe to it, click on the bell icon immediately. Okay. These are the two new batches just now started. Okay. February 20th. Okay. So ABM, BFM, ABFM, BRBL, all the four subjects are covered. Numericals, objective questions, case studies, everything is covered. 80% off is going on right now. Double validity on Mahapacks. Go for it immediately. If you are having the app, in app you will be getting 1% extra. Use the code Y432. I'll come to this later, okay? So, yesterday I had asked you one question for homework. That homework question was, in financial market, bond prices and yields are. So what are they? Inversely related, directly related, inversely or directly related depending on the type of the bond, and none of these. So what was the correct answer? Many of you gave the correct answer. Correct. Bond prices and yields are always inversely related. It means what? Yield means asking rate. If the yield goes up, the price of that bond, price of that bond will go down. Always remember this. Okay, if yield goes up, the price of the bond goes down, and vice versa. Okay, the risk on the stock portfolio which cannot be eliminated or reduced by placing it in diversified portfolio is classified as. Means, what do you mean by diversified portfolio? See this, the question over here is, if I firstly understand portfolio risk means what? Portfolio means what? It's a combination of various stocks or bonds. If I buy various bonds, it's very less chance that all the bonds will go down. Some bonds and some stocks will go up. So that is a major advantage. That's why mutual funds exist. What are MFs? What are mutual funds? What is an MF? MF is a combination of all the stocks and bonds, right? I invest in Reliance, Tata, then this Adani stocks and various stocks. So if one stock goes down, others will do the solidarity, and they will take this maintain my portfolio. Okay. So the point over here is, it's like this portfolio, but which is the risk which cannot be avoided even this MF or even in this portfolio? Diversifiable risk, market risk, stock risk and portfolio risk. Which is the risk which cannot be avoided over here? Yes, let me call this ABCD. Okay, A, this is B, this is C, and this is D. So which is the one which cannot be avoided? The correct answer is B, market risk. Market risk cannot be avoided. See here, market risk means what? Any event which is not in your hands. Which is not in your hands. So you can't avoid it, but obvious, isn't it? So market risk cannot be avoided at all. Risk associated with the portfolio is always less than the weighted average of risk of the individual items in the portfolio. Due to, means, if I am having only Reliance shares, imagine I am having, let's say, 1 lakh rupees and I invest in only Reliance shares. Reliance. Or I am having 1 lakh rupees and I invest in 4 separate companies, 25,000 each. Reliance, then Tata's, some Tata company, then Adani, then some Hindustan Lever, okay, Hindustan Unilever. So I invest in these 4 companies. So if single Reliance goes down, and in case 1, my whole portfolio will go down. My full 1 lakh will be affected. But here, if single Reliance goes down, it may happen that Tata and this Adani and HUL, they will pick up the stocks of mine. Okay, that they'll maintain the portfolio, and that's the beauty of always portfolio management. So risk associated with the portfolio is always less than the weighted average risk of individual items in the portfolio due to Number one, diversification of risks. Number two, the facts that all accounts in the portfolio will not behave in the unidirectional manner. What do you mean by the same? It means Reliance goes down, so others may not go down. Right? So all the accounts in the portfolio will not behave in the unidirectional manner. The fact that risk in all the accounts in the portfolio will not materialize simultaneously, and both A and B. So the correct answer is what? Diversification of risk, right? Then all of them will not behave in this unidirectional manner. So the correct answer is D, both A and B, right? Because will not materialize simultaneously means what? It means that all the stocks will not come to you for payment. It never happens in stock. This is obviously not the feature of any portfolio management. Only A and B are the answers over here. Okay, mainly in any portfolio we have diversification of risk, means we diversify the money risk in this while investing. Okay, and why? So that all of them don't move in the same direction. Aggregated risk of all stocks together as a whole is called as of all stocks together. Means a same example. Let's take this again. Reliance, Tata, then let's take Adani, then Hindustan HUL. Okay. So all stocks combined 25,000 year, 25 year, 25 year, 25 year. So the combined risk of all these is known as what? Transaction, portfolio, total, and none of these. Many of you will get confused between B and C, portfolio and total. A is not the answer, okay? And also D is not the answer. So only answer is B or C. So which is the correct one? B or C? B or C? Portfolio or total? The correct answer is portfolio, okay? This all the combined stocks together, or not only stocks, it can be bonds also. All the combined bonds together, or a combination of stocks and bonds. Okay, so that is called as portfolio risk. A portfolio consists of all stocks in the market. In a market is classified as, means if a portfolio consists of all stocks, let me write this bonds also over here, because we banks deal in bonds as well as stocks. Okay, a portfolio consists of all the bonds or stocks in the market is classified as market portfolio, a return portfolio, correlated portfolio, and diversified portfolio. Let's mark this A, B, C, D. Okay, answer this as A, B, C, or D. A, B, C, or D. So this is known as what? Which consists of all the bonds or stocks in the market. It is called as market, return, correlated, or diversified. The correct answer is yes, diversified portfolio. It is nothing called as market portfolio. All the stocks and bonds in the, whenever we have a portfolio, it's obviously a market portfolio. You can't buy anything which is not available in the market. Logic, isn't it? Return portfolio, there is nothing called as return portfolio. Correlated, that is again illogical. Correlated means the portfolios, of course correlation is a part of the portfolio. It's a study, it's called as a beta. Okay, that beta is to be studied, but that doesn't mean portfolio. And that is a method of studying. So the correct answer is diversified. Okay. Before moving ahead, see this, 80% off is going on all the batches, ABM, BFM, ABFM and BRBL. All the 4 subjects are covered. Target batch, okay, this may be the last batch, I think so. Okay, so join this batch ASAP, don't miss the bus. Okay, February 20th just now started, double validity on Mahapacks. Mahapack means 15 plus batches for each of these subjects. Use the code Y432. I'll show you how to use the code at the end. Okay. In the asset portfolio, the number of stocks are increased to, means suppose imagine, I'll give you the same example, 1 lakh. Okay. Then I invest in 4 stocks, 1, 2, 3, 4, Reliance, Tata, all these names. Okay. Instead of investing in 4 stocks, 25,000 each, now I invest in 10 stocks. Okay. So now I invest in these, let's say 10 stocks. So invest 10,000 in each. So what is the advantage of taking 10 stocks instead of 4 stocks? Reduce return, reduce the average, reduce risk, and increase prices. So again A, B, C, D. Okay, type fast A, B, C or D. What is the correct answer in this? Means why do I invest in a large number of portfolio stocks or bonds, okay, rather than investing in smaller number? That will do what? That will reduce the risk, correct? The C is the correct answer, because returns can be reduced, okay. If you invest in more stocks, there are more chances that your returns will be increased, depending on what level of stocks you select, okay. So you should always go for stocks, not only stocks, bonds also, any investment, okay. You must always select A graded stocks, bonds, or any investment, okay. So what is the advantage of increasing number of stocks or bonds in a portfolio? It is reduced risk, okay. Mostly in financials, the risk of a portfolio is smaller than that of the assets. Smaller than that of the assets, mean, weighted average, mean correlation, negative correlation. Again A, B, C, D. This is a difficult one, not that simple, okay. A, B, C and D, okay. So what does it mean? Risk of a portfolio is smaller than the risk than assets. Means assets mean, again let's take the same example of four shares, Reliance, Tata, and let's take three only now. Reliance, Tata, and which one? Adani, okay. So let's take these three companies. So the portfolio of these three will have a less risk, okay, than the individual Reliance. Why individual Reliance? Because see this, how it is done, how it is calculated. See this, in any portfolio management, we never take the mean. Simple mean is never taken. We always go for weighted average. Always remember, the portfolio risk of a portfolio is always smaller than the assets weighted average. Then mean correlation, that is different. Correlation means again beta, that is called as one of the important parameters of studying whether the portfolio is correlated to each other directly or inversely. And negative correlation, that is again beta. See this, both are beta. This is negative beta, this is positive beta, okay. So that is basically the method of correlation, or studying the relationship between the bond or the stock and the portfolio. But the risk in the portfolio is smaller than what? Weighted average. Remember this. Even, okay, let me ask you one question. As this weighted average concept has come, have you heard this word WACR, weighted average call rate? Has anyone heard about this? Weighted average call rate? Just type yes in the comment section if you have heard it. Weighted average call rate should always be equal to repo rate. This is a basic parameter which RBI uses. Okay, that's why as this topic had come of weighted average, I remember this WACR. Weighted average call rate will always be equal to repo rate. Okay, so that is the way, that is the meaning of weighted average. Weighted average means what? It suppose means it's basically, there are two types of averages in any finance. One is simple average, that is mean, and second is weighted average. So all the finance parameters are based on weighted average mainly. Some of them are based on simple average also, but mainly weighted average. Which of the following statements is correct? We want true now. True. Okay, we don't want false now. The funding risk may arise from the need to replace net outflow due to unanticipated withdrawals of deposits. So this funding risk may arise due to what? Need for replacement, net outflows due to unanticipated withdrawals. Means if the withdrawals are more in my bank, okay, if there are huge withdrawals, then what happens? I definitely face the funding risk. Okay, the time risk arises when the performing assets turn into NPAs, non-performing asset. This is NPA. So this will definitely affect the time risk. What is time risk? Time risk means when I want the money for payment, I don't have money. When will this happen? If my loans become NPA, what will happen? They won't pay me the interest. If they don't pay me the interest, how will I pay the interest to the depositors? So that is time risk. Call risk arises due to crystallization of contingent liabilities. So crystallization, contingent means what? Future liabilities which are not presently taking away my cash. Okay, like LC, bank guarantee, BG. Okay, these are all contingent liabilities. So Call risk arises due to crystallization. Crystallization means the actual money is going out. Money goes out. That is called as crystallization. Money goes. Okay. So this company whom I have given the bank guarantee, that company will come to me. This is your guarantee. Now give me my money. So in that case, my money will actually flow out of my bank. So that is known as crystallization. So which of the following statements is correct then? Funding risk may arise due to withdrawals. Yes. Time risk because of NPAs. Yes. Call risk because of crystallization. Yes. So the answer is yes, yes, D. All of these, isn't it? So the answer is all of these, isn't it? All of them are correct. None of them is wrong, right? The features of interest rate risk are, what is the feature of interest rate risk? It is an exposure of banks' financial conditions to adverse movement in interest rates. So adverse movement, this is an important part in this bond calculations. Okay, if the interest rate moves in your adverse direction, then you will always face the interest rate risk. It has direct effect on net interest margins. Yes, it has direct effect, because if the interest rate goes up, the prices of my bonds will go down, and as the interest rates goes up, the FD rates will also move up. Okay, so that's why it has a direct impact on my NIM. It may also affect the market value of the equity, but obvious, if the interest rate goes down, the share price of the banks generally go down. Why? Because FD rates would be higher. So the correct answer is all of these. Okay, got it? Interest rates will always have a negative impact on the stock value of the banks. Okay, one for your homework. The portfolio which consists of perfectly positive correlated assets having no effect of negativity, positivity, correlation and diversification. Now ABCD, again these are, okay, just check this and answer me tomorrow. Okay, I'll be answering this tomorrow in tomorrow's session. Okay, now I was going to show you about this Y432, how to use this code Y432. Let's go to Adda 24/7 live. If you're having the app, I would suggest go on the app. Okay, in the app what do you get? See this, in app you'll be getting 1% extra. Go to Adda 24/7 live over here. Look at this. Okay, yeah, click on JAIIB and CAIIB. Click on CAIIB 23. Now CAIIB 23, you will be seeing these. See this batches. Click on the first batch. You will see the details. What are the timings? What are the dates? What are the study plans? Everything you will see it over here. Okay. Then you are having this. Let's look at the fees part. Also, there are recorded videos available 24/7. So if you miss out on any class, you can definitely get back to it. Okay. 2 interactive classes are available, ebooks are available, tests are available. What do you need? That much is enough. Let's look at the fees part. 23,999, click on view offers. Put the code Y432. Click on apply. Now look at this. 23,999 reduces to 4,799. 80% off you are getting. Such a huge discount offer. It won't last long. Grab it immediately. Go for the Mahapack, I would say. In fact, see this, in Mahapack, I'll show you what is Mahapack. See this. Go to Adda 24/7 live again on the front page. See, in JAIIB, CAIIB, Mahapack. In Mahapack, click on CAIIB ka Mahapack. Look at this. Again, you will get the details over here. 15 plus batches. Okay, 15 plus batches for ABM, BFM, ABFM and BRBL. Okay. Case study batches are available, mock tests are available, topic wise question banks are available. So what all do you need? 15 plus batches per subject. It's not a joke. Okay, so you'll definitely learn better, learn more. In fact, just attend per subject one batch also. 15 batches if you attend, you'll learn it, isn't it? Click on view offers. 35,996. Click on view offers. Put the code Y432. Click on apply. Now look at this, 35,996 reduces to 7,199 and the validity is what, 12 months, 6 plus 6. See this validity won't last long for 12 months. It is generally for 6 months. This time it is given for 12 months. So that's an offer. Go for it immediately. Divide the 7,199 by 12 months. You get what? Roughly what? 600, isn't it? 600 for 30 days, 1 month 600 per day. Per day it is 20 rupees. If you divide this by per day, you'll get it 20 rupees. 20 rupees we spend it on tea and coffee in the breaks. Okay? More than 20. Nowadays nothing happens in 20 rupees. Now it's around 100 rupees per day, isn't it? But this 20 rupees per day will give you an investment for lifetime. Go for it. Why am I stressing on these batches? Because look at this. The portion for CAIIB has changed. Okay, look at this portion. The portion for CAIIB is tougher now. ABM, BFM, ABFM and BRBL. So it has gone tougher. Earlier you had only 2 subjects, now you have 4. And these are totally new subjects. Even the electives, you had retail earlier, now no retail. Rural, HR, IT, central banking and risk. Okay. Negative marking has been removed, so that is a good sign for you. Okay. You can definitely join the batches. I would suggest you join the batches, and